The silver market did not stumble at the end of 2025 because fundamentals suddenly weakened, sentiment collapsed, or a speculative bubble burst. It stumbled because it ran headfirst into a structural boundary that still exists inside the global financial system, the tolerance limit for visible price signals. When silver surged nearly 150% in a single year, outperforming equities, outperforming crypto, and breaking nominal highs that had stood for decades, it stopped behaving like a marginal asset and started behaving like a signal. And signals are dangerous to systems that rely on perception management. The speed and timing of the late December collapse matter far more than the magnitude. A near 10% drop in just over an hour during the thinnest liquidity window of the global trading day is not how organic markets correct. Organic corrections distribute across sessions, migrate across regions, and invite two-way trade. What happened instead was a vertical move executed when participation was lowest and impact was highest. That alone tells you the objective was not price discovery, it was price interruption. Silver had crossed from being tolerated to being inconvenient. The rally into the low 80s was already challenging narratives around inflation control, monetary normalization, and asset stability. When prices in China pushed toward the high 80s, the signal became global. At that point, allowing continuation would have meant accepting that silver was no longer repricing quietly, but loudly. Systems that depend on confidence rarely allow loud repricing of monetary metals. The history of precious metals markets shows this pattern clearly. Suppression does not occur randomly, and it does not occur continuously. It occurs at inflection points where price action threatens to alter behavior. In the early 1990s, gold's rise threatened inflation psychology. In 2011, silver's surge threatened confidence in fiat stability and leverage structures. In late 2025, silver ES breakout threatened to expose a deeper imbalance between paper claims and physical availability at a time when debt levels, geopolitical risk, and industrial demand were all converging. This is why the context matters. Silver did not rally in isolation. It rallied alongside platinum, gold equities, and real assets broadly, while equities reached record concentration and debt reached record scale. That combination reduces the system's margin for error. When silver moved from the low 70s to the mid 80s in a matter of days, it compressed years of repricing into weeks. That compression is what triggers intervention, not because prices are too high, but because they are rising too fast relative to the narratives that anchor risk models. The concept of manipulation is often misunderstood because it is framed as an attempt to permanently control prices. That is not how it works. Long-term suppression is about managing the rate of change, not the destination. Even during the two-decade gold suppression that began in the early 1990s, prices eventually rose. What was managed was the speed and timing, particularly around crises. Rapid appreciation of precious metals during stress events undermines confidence in policy responses and encourages capital flight. That is why interventions cluster around moments of stress, not moments of calm. The late December silver event fits this pattern precisely. The market had already absorbed a year of extraordinary gains. It had already accepted prices above historical highs. What it had not yet absorbed was acceleration. Acceleration forces repositioning. It forces hedging behavior to become visible. It forces institutions to explain why an asset with no yield is outperforming everything else. That explanation is uncomfortable when debt levels are extreme and monetary credibility is fragile. The mechanics of the move reinforce this interpretation. High-volume futures selling into an illiquid session is the textbook method for triggering stop-loss cascades and margin liquidations. No large institutional hedger seeking best execution would choose that window, but an actor seeking maximum psychological and technical impact would. The absence of a sharp rebound afterward is also revealing. Flash crashes, driven by panic, tend to snap back quickly once liquidity returns. This move did not. That suggests the selling pressure was not simply exhausted fear, but part of a broader effort to reset positioning before the next phase of trading. Importantly, this reset occurred before the Chinese market opened. That timing is critical. Silver pricing in China was already diverging upward, reflecting stronger physical demand and different incentive structures. Allowing Western paper markets to open with silver already near new highs in Asia would have risked accelerating arbitrage flows and exposing the disconnect between paper liquidity and physical supply. By forcing a sharp reset beforehand, the system bought time. Time is often the real objective of intervention. Time allows positions to be adjusted, narratives to be prepared, and pressure to be diffused. This does not mean the bull market is over. It means the market crossed into a zone where resistance is structural rather than speculative. The question is not whether silver is strong, but whether the system can tolerate that strength being expressed cleanly. History suggests it rarely can, at least not without periods of forced volatility. What makes the current episode different from earlier cycles is not the existence of suppression, but the environment in which it occurs. In 2011, speculative positioning had built for years. Leverage was extreme and physical constraints were less binding. Today, positioning built rapidly, leverage is already constrained by regulation and margin policy, and physical availability is tighter due to industrial demand, supply chain localization, and export controls. These differences matter because they limit how far and how long suppression can be effective. Suppression works best when there is ample supply, weak underlying demand, and speculative excess to flush out. It works poorly when demand is structural, supply is constrained, and price signals are being watched by actors outside the traditional Western financial system. The late December move should therefore not be read as a verdict on silver's direction, but as evidence that silver has become systemically relevant again. Assets that are irrelevant are ignored. Assets that matter are managed. The very fact that silver required management at this stage of the cycle tells you that the bull market has not exhausted itself. It has reached a point where its implications are no longer comfortable. Whether the bull continues roaring or the bear reawakens depends less on short-term price action and more on whether the forces driving demand can be neutralized. That question cannot be answered by charts alone. It must be answered by examining inventories, lease rates, industrial policy, debt dynamics, and capital flows. And when you do that, the picture becomes far more complex than a simple repeat of 2011. What separates a temporary intervention from a genuine trend reversal is not the violence of the initial move, but the System ES ability to sustain the new price regime afterward. In 2011, silver collapsed not merely because prices were pushed lower, but because the underlying structure allowed the push to propagate. There was ample paper supply, speculative leverage was extreme, and physical demand was not yet anchored by long-term industrial commitments. Once confidence cracked, there was nothing beneath the market to absorb the weight. Today, that structural emptiness no longer exists. The market that absorbed the late December shock did so without cascading into disorder. Prices did not unravel across weeks. They stabilized, recalibrated, and remained historically elevated. That is not the behavior of a market whose bull case has been invalidated. It is the behavior of a market undergoing forced digestion. Digestion is uncomfortable, volatile, and often misread as rejection, but it is a prerequisite for continuation. The key distinction lies in who is holding the metal and why. In prior cycles, silver ownership was dominated by speculative actors seeking leverage-driven upside. Their time horizon was short, their tolerance for drawdowns was limited, and their conviction was often conditional. In the current cycle, a growing share of demand is coming from actors with fundamentally different incentives. Industrial users are not trading silver, they are securing inputs. Sovereign and quasi-sovereign entities are not momentum chasing, they are diversifying reserves and supply chains. Long-term investors are not reacting to intraday volatility, they are reallocating capital away from saturated asset classes. These participants do not respond to price suppression by exiting, they respond by reassessing availability. When availability is questioned, demand becomes less elastic. This is where suppression loses effectiveness. Pushing prices down in such an environment does not flush out weak hands in the same way. It transfers metal from impatient holders to patient ones. Over time, this transfer tightens the market. Elevated lease rates are a symptom of this tightening. They indicate stress in the physical lending market, where promises to deliver metal in the future are becoming more expensive to maintain. Lease rates rise when metal is scarce relative to demand for immediate use. That scarcity cannot be engineered away with paper selling. It can only be deferred. Deferred scarcity often reemerges at higher prices because the cost of deferral accumulates. This dynamic explains why silver rebounded toward prior highs relatively quickly after the late December event. It also explains why price suppression today looks more like a break than a reversal. Breaks slow momentum. They do not change direction unless applied continuously and with increasing force. Continuous force is costly. It requires inventory, credibility, and coordination. The higher global debt levels climb, the more costly it becomes to maintain such force. Debt constrains policy flexibility. It limits the ability to absorb shocks without signaling weakness. Precious metals thrive in that signaling gap. They rise not because systems fail outright, but because systems must increasingly manage appearances rather than outcomes. The Greenspan era logic remains relevant. Rising precious metal prices function as thermometers of confidence. Suppressing the thermometer does not cure the fever, but it can delay behavioral responses. Delay has value when managing expectations, but it also compounds underlying imbalances. This is the trade-off policymakers and large institutions face. Allow prices to rise and risk accelerating capital flight, or intervene and risk tightening physical markets further. Neither option is clean. This tension is precisely why silver AS future path is unlikely to resemble a simple replay of past cycles. The geopolitical overlay intensifies this complexity. The strategic importance of raw materials has increased dramatically. Supply chains are no longer optimized purely for cost. They are optimized for resilience, redundancy, and political alignment. That shift raises the minimum price required to incentivize production, storage, and stockpiling. Price suppression runs counter to this objective. You cannot encourage domestic or allied supply investment while simultaneously signaling that prices will be capped whenever they move too quickly. At some point, those incentives collide. The late December intervention appears less like an attempt to kill the rally and more like an attempt to smooth it. Smoothing is an admission of inevitability. It suggests acceptance of higher prices, but resistance to the pace. This interpretation is reinforced by the behavior of Chinese markets. Silver prices in China reaching significantly higher levels than in Western markets reflect a different risk calculus. Chinese investors and institutions are less exposed to Western paper market narratives and more focused on securing physical assets amid domestic real estate stress and global trade uncertainty. This divergence creates pressure on arbitrage mechanisms. When arbitrage becomes constrained by export controls, logistics, or regulatory barriers, regional price differences persist. Persistent differences undermine the notion of a single global price. That fragmentation is itself bullish for physical holders because it reveals that paper benchmarks no longer fully represent marginal demand. The gold to silver ratio provides additional context. While it has compressed meaningfully from extreme levels, it remains far from historical lows seen during prior peaks. Ratios do not revert mechanically, but they do reflect relative scarcity and demand. Silver's underperformance relative to gold over many years created latent potential that is now being realized. That realization does not require speculative mania. It requires only that silver regain its dual role as monetary and industrial metal in a world where both functions are increasingly relevant. Gold's role as a reserve asset is well established and reinforced by central bank behavior. Silver's role is more dynamic, but that dynamism is an advantage. It allows silver to participate in monetary repricing while also benefiting from real-world investment cycles. The risk, often cited by skeptics, is volatility. But volatility is not inherently bearish. It is a transfer mechanism. In markets undergoing structural change, volatility redistributes ownership toward those with longer horizons. Each sharp move tests conviction. Those without it exit. Those with it add. Over time, this process reduces the pool of reactive sellers. The result is not a straight line higher, but a stair-step pattern where each consolidation occurs at a higher plateau. That pattern is already visible when viewed over a multi-year horizon. The late December event fits neatly into this structure as a stress test rather than a failure. Stress tests reveal weaknesses, but they also reveal resilience. Silver's ability to hold above levels that would have been considered extraordinary only months earlier speaks volumes. The question of whether the bull is still roaring or the bear is reawakening may therefore be the wrong framing. A more accurate question is whether the system can still afford to suppress signals without exacerbating the very risks it seeks to manage. As debt continues to accumulate, as geopolitical alignments harden, and as industrial demand for strategic metals intensifies, the cost of suppression rises. Markets eventually price that cost. When they do, the adjustment is rarely subtle. Another critical element that differentiates the current silver cycle from historical episodes is the changing nature of liquidity itself. In earlier decades, liquidity was assumed to be abundant, neutral, and continuous. Markets were built on the premise that paper claims could always be rolled, settled, or offset without friction. That assumption is now under strain. Liquidity today is selective. It appears in some assets and disappears in others. It favors scale, jurisdiction, and alignment with policy priorities. Silver exists in an awkward position within this framework. It is too strategic to be ignored, too small to absorb unlimited paper leverage, and too essential to be allowed to reprice freely without consequence. That combination makes it prone to episodic shocks rather than smooth trends. These shocks are not signs of weakness. They are expressions of stress within the market's plumbing. When futures volume spikes during illiquid windows, it reveals not confidence, but urgency. Someone needed the price lower quickly, and it was willing to accept distortion to achieve it. Distortion is costly. It leaves footprints. It widens, spreads, elevates lease rates, and incentivizes physical withdrawal. Over time, these costs accumulate. Markets can absorb occasional distortions, but repeated distortions change behavior. Participants adapt. They reduce reliance on paper exposure, increase physical allocation, or demand higher premiums for providing liquidity. Each adaptation reduces the effectiveness of future interventions. This is why suppression campaigns historically lose power over time. They rely on static behavior in a dynamic system. The silver market today is far more adaptive than it was in 2011. Information travels faster, alternative trading venues exist, and physical demand is geographically diversified. A sharp move in Australia is no longer isolated. It is instantly contextualized, analyzed, and arbitraged globally. This reduces the shock value of interventions. They still move price, but they do not fully control narrative. Narrative control was a key advantage in earlier cycles. Without it, price management becomes more resource intensive and less predictable. The debt backdrop amplifies this challenge. Global debt exceeding 250% of output is not just a statistic. It is a constraint on future policy responses. Servicing that debt requires either sustained growth, financial repression, or currency debasement. Growth is uneven, repression has political limits, and debasement undermines confidence. Precious metals sit at the intersection of these outcomes. They benefit from repression because yields are capped. They benefit from debasement because real value erodes elsewhere. They even benefit from growth when that growth is commodity intensive. This asymmetric payoff profile explains why metals can rise across different macro regimes. It also explains why attempts to suppress prices face headwinds. Suppression assumes a stable macro backdrop where interventions can be temporary and reversible. Today's backdrop is neither stable nor easily reversible. Each intervention occurs against a baseline of elevated risk. That baseline does not reset when price is pushed down. It waits. This waiting risk reasserts itself once the immediate pressure fades. The role of Western versus non-Western participation further complicates matters. Western investors remain underallocated to precious metals relative to historical norms, while equity exposure remains concentrated. This creates latent demand that has not yet fully engaged. At the same time, non-Western investors, particularly in Asia, are increasingly active, driven by different incentives and constraints. They are less sensitive to Western narratives about rate cuts or technical corrections. Their focus is on preservation, supply security, and long-term purchasing power. This divergence creates a two-speed market. Paper prices may wobble under Western pressure, but physical demand elsewhere provides a backstop. When these forces collide, volatility increases, but direction eventually asserts itself. The gold to silver ratio's behavior reflects this tension. While ratios can overshoot in both directions, sustained compression signals a rebalancing of relative value. Silver narrowing the gap with gold suggests that its hybrid role is being recognized. It is not simply following gold, it is carving out its own space within the broader precious metals complex. That space is defined by scarcity under industrialization and monetary stress. Suppression attempts may temporarily distort this process, but they cannot eliminate it without addressing the underlying drivers. Addressing those drivers would require resolving debt overhangs, stabilizing geopolitics, and restoring confidence in long-term monetary discipline. None of those appear imminent. This does not guarantee uninterrupted upside, but it does argue against a sustained bear market driven purely by intervention. Bears require supply, complacency, and disengaged demand. The current environment offers none of these in abundance. Instead, it offers constrained supply, cautious but persistent demand, and a system increasingly sensitive to price signals. In such an environment, sharp declines are more likely to be tactical resets than structural reversals. They serve to rebalance positioning and relieve immediate pressure, but they also reinforce awareness of underlying fragility. Each episode teaches the market where the boundaries lie. Over time, those boundaries shift. The late December event taught participants that silver's ascent will not be linear, but it also taught them that the system still reacts when silver moves too quickly. That reaction is itself information. It tells you where the pressure points are. Markets price information, not just assets. When information suggests that an asset's movement is constrained because of its signaling power, that asset gains strategic relevance. Strategic relevance attracts long-term capital. Long-term capital reduces downside elasticity. This is the loop now forming around silver. Whether the bull roars loudly or advances unevenly is less important than whether the underlying forces remain intact. At present, they do. And as long as they do, suppression may shape the path, but it is unlikely to change the destination. What ultimately determines whether suppression evolves into reversal is the behavior of capital after the event, not during it. Markets can be pushed, startled, or redirected temporarily, but sustained trends only reverse when capital reallocates decisively away from the asset in question. That is not what the post-event landscape in silver suggests. Instead of broad disengagement, what followed was recalibration. Volatility increased, narratives fragmented, but commitment did not evaporate. This distinction is subtle yet decisive. In genuine bear market transitions, participants do not debate structure. They exit. Liquidity thins, not because it is attacked, but because interest disappears. In silver's case, liquidity thinned precisely because interest remained, and too much size tried to move through too narrow a channel. That congestion is characteristic of markets in transition, not markets in decline. The late December price action exposed how sensitive silver has become to marginal flows, a sensitivity that only exists when inventories are tight relative to demand. If inventories were ample, aggressive selling would have found natural absorption without drama. Instead, the move required timing, leverage, and surprise. all hallmarks of a market where organic supply is insufficient to enforce discipline. This matters because it reframes the role of futures markets. Futures are often treated as neutral venues for price discovery, but in stressed environments, they become tools for timing rather than valuation. When valuation is contested and timing is decisive, power shifts to those who can move first, not those who are right. However, first mover advantage diminishes as more participants anticipate intervention. Anticipation breeds defensive behavior. Defensive behavior tightens supply further. This feedback loop gradually erodes the effectiveness of suppression. It does not do so dramatically. It does so incrementally through higher costs, lower elasticity, and increased volatility around a rising equilibrium. That equilibrium is shaped by fundamentals that operate on longer horizons than trading strategies. Industrial demand does not disappear because futures prices dip. Strategic stockpiling does not reverse because volatility spikes. Capital-seeking diversification does not abandon positions because price action becomes uncomfortable. These forces persist. Over time, they assert themselves through higher average prices, even if peaks are contested. This is why framing the current environment as a binary choice between bull and bear misses the point. The more accurate framing is one of contested repricing. Repricing is rarely smooth when it touches politically and economically sensitive assets. Silver sits at the intersection of monetary signaling and industrial necessity, making it uniquely sensitive to this contest. The system's response has been to slow the repricing, not to deny it. Slowing is a rational strategy when outright denial would provoke unintended consequences. But slowing also prolongs tension. Prolonged tension invites more scrutiny, more adaptation, and more participation by actors, who are less sensitive to short-term noise. Each cycle of intervention and stabilization educates the market. Participants learn where intervention is likely, how it is executed, and what it cannot accomplish. That learning changes behavior. Stops are placed differently. Exposure is structured differently. Physical allocation increases. Paper leverage decreases. All of these adjustments reduce the shock value of future moves. They also reduce the system's ability to engineer clean reversals. In 2011, intervention coincided with widespread speculative exhaustion and regulatory tightening that amplified downside. In the current cycle, intervention collides with structural demand and constrained supply. The outcomes are therefore asymmetric. Downside moves are sharp but limited. Upside moves are slower but persistent. This asymmetry is the hallmark of markets transitioning from speculative to strategic ownership. Once an asset enters that phase, its price path becomes less responsive to sentiment and more responsive to availability. Availability is the ultimate arbiter. The discussion of availability naturally leads back to lease rates, inventories, and regional price differentials. Elevated lease rates signal that promises to deliver silver in the future are being repriced because immediate delivery is valuable. This is not a speculative signal. It is a logistical one. Logistics rarely lie. When logistics tighten, markets eventually follow, regardless of paper narratives. Regional differentials further reinforce this message. When prices diverge across regions and remain divergent, it indicates friction. Friction undermines the premise of a single unified market. Unified markets are easier to manage. Fragmented markets resist control. Fragmentation is increasing, not decreasing. Export controls, localization policies, and strategic reserves all contribute. Silver, as a metal embedded in technology and energy systems, is particularly affected. The more fragmented the market becomes, the less effective centralized price management will be. This does not imply chaos. It implies decentralization of price discovery. Decentralized discovery tends to favor assets with strong local demand and limited substitutability. Silver fits both criteria. The broader macro backdrop reinforces this trajectory. Rising global debt, shifting monetary regimes, and geopolitical realignment create persistent uncertainty. Uncertainty does not automatically drive prices higher, but it does increase the value of assets that are not liabilities. Precious metals are among the few financial assets that do not represent someone else's obligation. This attribute becomes more valuable as obligations proliferate and confidence in their servicing wanes. The late December silver move occurred against this backdrop, not in isolation. Interpreting it without reference to these forces risks misdiagnosis. The move was not a verdict on silver's fundamentals. It was a reaction to their visibility. Visibility is the enemy of quiet management. Once an asset's repricing becomes too visible, it invites response. That response, in turn, validates the asset's relevance. This paradox is central to understanding precious metal cycles. The more they matter, the more they are managed. The more they are managed, the more their role as signals is confirmed. This feedback loop does not resolve quickly. It evolves. Participants adjust expectations. Volatility becomes normalized. Price ceilings become temporary. Floors rise. Over time, what once required intervention becomes accepted. That acceptance is the endgame of repricing. It is not achieved through uninterrupted rallies, but through repeated tests. Each test either weakens or strengthens the case. The late December event, rather than weakening the case for silver, strengthened it by demonstrating both the system's sensitivity and the market's resilience. The bull may not roar continuously, but it does not need to. In markets driven by structural forces, persistence matters more than volume. The bear, if it were truly reawakening, would require disengagement, excess supply, and a restoration of confidence elsewhere. None of these conditions are present. What is present is a market negotiating its place in a changing system. Negotiations are messy. They involve pushback. But they also reveal priorities. And the priority revealed by recent events is not to suppress silver indefinitely, but to manage its ascent. That distinction makes all the difference when assessing what comes next.